Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect the premium upfront and generate consistent returns year on year. So the first thing we need to do is open up your brokerage platform. The one that I use is Tasty Trade. You can use whatever you like. And of course we are going to be writing or selling options contracts. So we need to know where we are in the option cycle. So we want to come over to the trade tab and we want to just pull up something like, say, Apple, just to get a list of expirations. And now we can see a full list of expirations for equities. Everything with a orange W is a weekly expiration, and everything else is a monthly expiration. We want to be between 30 and 60 days out in time. 45 days is perfect, but we also want to avoid the weeklies. We just want to stick with the monthlies. So the next monthly available is October 18th. That's 11 days away. That is a little bit too close. So we are going to go out to November 15th, and that is 39 days away. It is a little bit on the short side. However, it's still okay. We'll probably stick with the November 15th expiration until we get down to about 35 days ish, and then we can make a judgment call from there. But for right now, 39 days is perfect. So we can take this information, come over to our watch list. It's just any watch list, and we want to filter out everything that has earnings over the next 39 days. And the reason for this is because earnings can cause a negative effect on your P&L. It can increase your volatility. It can almost certainly mess about with your deltas, and overall it's not going to be a fun time. So we want to remove all underlyings that have earnings over the next 39 days, and we also want to remove any underlyings that have a low liquidity level as well. And what we'll be left with is a list of things that are very liquid to trade and don't have earnings. Finally, we just list everything from high IVR to low IVR. We want to sell when volatility is high and play the contraction back down to the mean and hopefully even further below that. And at this point, we simply just want to go down the list and see what looks nice for us. We also want to keep in mind with the IV rank, anything above 50 is considered high, anything below 50 is considered low. However, there are exceptions to that every now and again, especially with ETFs. For example, we've got IWM here. It's just the first thing that popped into mind, and with an IV rank of 39.8. Of course, we've got things here that have a much higher IV rank. For example, we've got GLD with 71.3, and we've got JD with 100. JD, Baba, and Baidu have been pretty high, and FXI have been pretty high for a little while now in the IV rank. Hopefully we can see a contraction on that, but we have looked at those stocks previously. We looked at XLE quite a lot, and the IV rank on XLE is 65.1, which is super nice for an ETF. So I think in this case, we'll go with IWM just to hit home on the point that an IV rank of 40 can be okay with something like IWM. So we come over to the trade tab, and of course, we are going to be 39 days out, November 15th. And now we are presented with the options chain, and the orange line here shows you where price currently is with respect to the strikes. The vertical orange bar shows you what the expected move is of IWM over the next 39 days. So what are we going to sell? Where are we going to sell it? How do we make money from this? So there's two types of contracts, a call and a put. We want to sell one call and one put, and we're going to sell them outside of the expected move because of course we're selling the contracts, so we're shorting them essentially, and we want to buy them back at a later date for a lower price, or they can just expire worthless. So we want to be selling our contracts outside of the expected move to let theta decay on the value on those contracts. So I like to go anywhere between a 15 or 16 to 20 delta with IWM. Very liquid, lots of strikes to choose from. I mean, we can just go with an 18 delta here, the 235 strike. And then if we do the same thing again on the put side at the 201, 18 delta again. And as you can see here, our strikes are outside of the expected move, and that is going to lead to a very high probability of profit. And we can see that here with a probability of profit of 70%. And if we wanted to get out of this position at 50% of max profit, then we've got an 80% chance of that happening. So very, very high probabilities. And if we were to mock this up on a chart, we can have a look and see what that would look like. So our strikes would be at 235 and 201. So 235 and 201. It's about there. So this is where our strikes are. And we've essentially created a range for ourselves. And what we want to happen in this situation is we want the price of IWM to stay within this range, or even if it goes outside of this range, we want it to expire within this range. And when is the expiration date? The expiration date is 39 days out in time, November 15th. So on November 15th, if price is within this range, then we will be able to keep 100% of the premium that we collect. So what is the premium that we collect? That's what this number is down here, $3.58. It's times by 100 because there's 100 shares per contract. So it's $358 that we would collect up front, as can be seen here with our max profit. And our broker is going to require 2.7k in buying power to open this position. Now, this is a pretty nice return on capital trade, especially for an ETF. It's got an implied volatility level of about 27.8 at the November 15th expiration. So all in all, this is looking like a very nice trade, very high probability of profit, $12 of daily theta decay. It is a limited risk because it's a naked position. And if that does concern you a little bit, or if the buying power requirement is a little bit too big for your account, by all means, you can always just buy another contract a little bit further out, say $5 wide. So 235 plus $5 would be 240. 201 again, same thing at the 196, $5 wide. And what we've basically done is created a $5 spread on either side. So you buy a contract a little bit further out from the one that we're selling. And what this does is it massively reduces the buying power requirement. And the reason for that is because our max loss is no longer unlimited. It's now defined by the spread between the two strikes minus whatever the premium is that we collect. And that's what our max loss is. So that's how you can find positions, and that's how you can also manipulate positions to fit your portfolio. There is one other thing that you need to keep in mind, and that is the size of your positions. It doesn't matter what you do. If the size of your positions are wrong, then eventually it won't end well for you. So the way it works is you enter in the size of your portfolio. Let's say if it's $5,000. Below that, you can then enter in the current VIX level. Let's say if it's 21.3. Everything below will then be automatically calculated for you. And at this point, all you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, how much of your portfolio you should allocate to short premium strategies in general. And as long as you keep this in mind, you'll be good to go. Everybody can get access to this completely for free. Just click the link in the description, head over to free position sizing template, and it'll take you to where you need to go. If you want to get involved on the positions that we're placing in our portfolios and you want to make money with us, by all means, again, click the link in the description, head on over to EDS Premium and get yourself signed up. Inside, you will have access to all of our portfolios, so you can basically copy trades from small and large accounts based on what the size of your account is. And there's also a full course, so you can no prior knowledge is required. It allows you to learn and earn at the same time. There's also a private community. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So once you've studied through the full course and followed our trades for 6 months, if you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. And right now it's £1 a month to join. The price will be increasing. However, once you're in, you're in. You don't need to worry about price increases. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.